is what we all want to happen when we invest our money. Sadly, as we know, it doesn't really work like that. A more common experience is this. Investments will rise and fall in value from time to time. The goal is to ensure the long-term rise is at the optimum level for your attitude to investment risk. In seeking to optimize long-term returns, we have to be very wary of losses. In particular, the 3 S's: steep, sudden, and sequential. Investors need to avoid these types of situations. The reason why investors should manage their position, aiming to avoid steep, sudden, or sequential losses, is because they devastate long-term returns. Think of cycling. It takes a lot more effort to cycle uphill than downhill. If you invest and lose money, the steeper the loss, the greater the recovery required, so it's harder to get back to the starting point. For example, if you lose 10% of your investment value, you need 11% return to get back to the starting point. If you lose 25% of your investment value, you need 33% to get back to the start, and 50% requires 100% future return. The steeper the loss, the higher the recovery required. Losses that are sudden leave no time for investors to react, or come at a bad time when investors do not have recovery options. Sequential losses may be smaller, but they happen for a few years at a time. This is not great for any investor situation, but especially bad for investors who require income from their investments. Rule number 1 of investing is therefore all about managing the downside risk. All investors should arm themselves with the best risk management tools available. However, unfortunately, there is no magic wand. The best risk management tool available to most investors is to diversify, and to do so skillfully. Diversification is the application of spreading your investments across different assets, with different risk levels, and finding the right percentage amounts for each part, and then managing this on an ongoing basis. It's the eggs in baskets analogy. The eggs in baskets are intended to represent the different types of assets, plus the percentage in each. What is an asset type or asset class? There are lots of different asset types, and they have different risk levels. How you split your amounts into each basket will determine your overall attitude to investment risk. It's this management of eggs into the basket that represents the asset allocation approach and the principles of diversification. It's how skillfully this is done that will determine the long-term outcome. Skilled diversification is the best way to risk manage your investment position. How do you know what amounts to allocate? Work with a skilled asset allocation manager who can help you determine this for your risk position. Very importantly, this should be reviewed, renewed, and rebalanced over time as circumstances change and results appear, because this will impact the percentages that are best at those different points in time. We work with our clients to strive for the optimum position and to help them with exceptional investment experiences. Verum Financial offers independent whole-of-market financial advice to families, individuals, and employers. Contact us for more information. Verum Financial. Financial advice you can trust.